Hello and welcome to Chapter 20, and we're going to talk here about some different ways companies can finance operations, known as hybrid financing, which have some qualities of equity and debt, and we're going to look at things like leasing, preferred stock, warrants, and convertibles. So we're going to start off with leasing, and leasing should be something everybody's pretty familiar with. If you think of leasing, you might think of leasing a car or leasing an apartment. And leasing for businesses is very similar. So anytime a business does a lease, they are going to sign a legal contract that allows them the use of something for a given period of time. It could be a vehicle, it could be factory equipment, it could be office space, or all of the above. And in the past, we would refer to leases as what is known as off-balance sheet financing because most leases were not capitalized. Prior to December 2018, you did not have to really record leases on your balance sheet as a company. And what is a lease? A lease is technically a debt obligation. You owe money, you signed a contract to pay to use something, but you didn't have to report it on your balance sheet, so it would allow you to look less indebted than you actually were. It's a substitute for debt financing, and we can use up our debt capacity by doing it. In December of 2018, accounting standards were changed. We passed something known as ASC 842 to correct this problem. So all leases now have to go on a company's balance sheet unless it is for 12 months or less. So unless it's an extremely short-term lease, they have to be what are known as capitalized and reported on a firm's balance sheet as a right-to-use asset. You report the years of the lease as an asset, and a liability is what is the present value of all of those lease payments. So now leases are accounted for on balance sheets unless they're extremely short term. If you lease a vehicle or a temporary office space for 6 months, legally you don't have to report that, but everything else you do. So that's how a lease works. And if you're a company, what can we do? Well, we can lease something, or we can borrow money via debt and buy the thing as well. So how do we make the determination of when is it more appropriate to lease or buy? We make that determination based on what is more appropriate for us, what is better for our company. So let's say we want to buy a new computer system and it costs after tax $975,000, our tax rate's 25%, and our cost of debt 10%. We have to spend $25,000 a year, beginning of each year, for maintenance, and we have a residual value in year 4 of $125,000. So that's if we choose to buy this computer system. After the 4 years we need it, we can scrap it and sell it for $125,000. If we lease, maintenance is included, and we just have a straight lease payment of $355,000 a year, payable beginning of each year. So in a lease analysis, what discount rate should we discount our cash flows? So in a lease, we're evaluating on an after-tax basis. We should use the after-tax cost of borrowing. So since our cost of debt is 10%, we should discount cash flows at 7.5. Very similar to what we did when we looked at the cost of debt chapter. We are just simply multiplying our cost of debt by 1 minus the tax rate, and we get 7.5%. Because we can write off our lease payments just like we can write off bond payments and things like that. Debt is tax deductible. So our effective cost of debt when we're looking at a lease is the cost of debt times 1 minus our tax rate, 7.5% here. So let's take a look at what it would cost if we buy the computer. So if we buy the computer, and this is all in thousands, we have a cost up front of $975,000. And our maintenance every year we are going to be paying after taxes. Here's our maintenance. Maintenance is $18,750. The reason it's not the full $25,000, we can write off part of it on our taxes as well. So that's why it says maintenance after tax. So we're going to have to spend $975,000 up front plus $18.75 effective immediately. And then for the next 3 years, we have a maintenance payment as well. So we have negative cash flows. Obviously, it's going to be negative because we're purchasing it. It's costs to us. And in year 4, our residual value, remember, is $125,000, but we have to pay tax on what we get, so in reality it's $93,750 or 93.75. Once again, all of this is in thousands. All of this is taking into account taxes. So what is our present value? You would just simply key into your calculator the present value of all of these, and or Excel, I would recommend just use Excel, use the PV function, and you can find the present value or the NPV formula. You can either find the present value of all of them or the net present value is the way to go. And by using our 7.5% rate, we get a PV of 972,003.31 or $972,310 or 972.31 negative. Why? Because that's what it would cost us. So if we choose to buy this computer system, the entire cost to us, present value, owning it the whole time, selling it at the end, is going to have a present value cost of $972,310. So if we're going to lease, we want the cost of leasing to be less, because we're indifferent to owning or leasing here, because we're going to get rid of this after 4 years regardless. We either lease it for 4 years and give it back, or we own it for 4 years and sell it. It's not like we have any use for this computer after this 4-year project. So as long as you're indifferent of buying or leasing, that would mean the time doesn't really matter. Because when you lease something, obviously you have to give it back, whereas if you own it, you could technically keep it till it's worn out. But most corporate decisions, you're just going to need whatever this product is, in this case a computer system, for the time of the project we are getting it for. So some notes on cost of owning. Asset was fully depreciated at time 0, so we didn't take annual depreciation. Each maintenance payment is tax deductible, so that's why we're using the after-tax ones in the previous slide. As I said, maintenance is tax deductible. Ending book value is 0 because we depreciated it all up front, so we have to tax the salvage. We fully depreciated it, meaning it's going to be worth nothing when we get rid of it. Since we were able to sell it for $125,000, we have to pay taxes on that $125,000, so we only pocket $93,750. So our cost of leasing, let's take a look. Leasing's easier. Why? Because we just have 4 lease payments and we're going to find the NPV of them. So find these and then add in the last one. You do not have to deduct this payment here, not deduct, excuse me. You don't have to find the present value of this payment because it's at year 0. We're making it today. Payments, if I switch to red, 1 through 3, those guys we have to find the present value of. So you would just find the net present value of these 3 payments and then add the negative $266.25. If you do that, you'll get $958,640. Our tax rate here is the same because lease payments are also tax deductible, and as a consequence, that is why our lease payments, instead of the $355, effectively they're really only $266.25. So they are tax deductible as well. So by finding the PV of this at our cost of debt, or 1 minus our tax rate, we would get $958,640. So we know our cost of owning, our cost of leasing, and if we look here, it is going to be cheaper to lease. $958,640 or $958,640. Whereas if we buy the computer system and sell it at the end, that's going to cost us $972,310. So net advantage of leasing is just the difference between cost of owning and cost of leasing. And if the cost of owning is more than the cost of leasing, you're going to get a positive number, and net advantage of leasing is a good thing. If the cost of leasing is more, you would get a negative number, therefore you wouldn't want to lease. So as long as you get a positive value for net advantage of leasing, you're going to want to lease more than buy because it's going to save us money. We would save $13,670 in today's money. Once again, this is all in present value, by leasing instead of owning, for the same 4-year time horizon, for the same computer system. So not always is leasing better. It all depends. But if leasing is cheaper than owning, companies would rather lease because it doesn't really matter to them. They just want to use this product for a given amount of time, and therefore, in this case, it makes more sense to lease. They would save about $13,670. So since the cost of leasing is less than owning, the firm should lease here. So net advantage of leasing, you'll probably see a question or two on the homework and the exams to come. And if you do, remember, if it's positive, leasing is better. If it's negative, owning is better. So what if there's a lot of uncertainty about the computer's residual value? So it could range from 0 to 250,000 and it's expected at 125. If we think it's really risky, we could use a higher discount rate to discount the residual value. So if we think it's more risky than normal, we could use a higher discount rate, and the cost of owning would be even more, and therefore leasing even more attractive. So if you're pretty sure you can get the 125, you would use your regular discount rate. If not, you might use a higher one. If you're really uncertain if the computer system would be worth anything, that would make leasing even more attractive here because it would raise the cost of owning even more. The reason owning was very close to leasing is we were able to get that $125,000 for the old computer system. If it's indeed worthless, well then leasing becomes even more attractive. So depending on what you're doing, a lot of times there is residual value to old equipment or computers or vehicles, but not always. So it all depends on what we're looking at. There's no one-size-fits-all approach here. But just realize if the residual value is more uncertain or lower, leasing would be even more attractive. So what if a cancellation clause was included in the lease? And a cancellation clause is just simply, remember, a lease is a legal contract. It might say after a year, the buyer, not the buyer, but the lessor, the person who is using the object, may be able to return it. So the lessee, excuse me, the lessor is the person that is giving you the object to use. So if we sign a lease on a vehicle and there's a cancellation clause, it might say we can give the vehicle back after a year if we don't need it. What's good about that? Well, it lowers the risk to the lessee or the person who leases the object. But it increases the risk to the lessor because now you may not have it leased for as long as you expected. Maybe you expected to have it tied up for 4 years and you were planning on getting all this income, and now you get the vehicle back after 1, and now maybe it's going to be a lot harder to lease because it's no longer new, or it may have a lot more use on it, or people don't need it, or bad economic times happened. So cancellation clauses, if they exist, and not all leases have them, it makes it less risky to the lessee or the person who assumed the lease because you can get out of it, but it increases risk to the lessor. And language in lease contracts greatly vary depending on what the thing is being leased and the term and all of that. Once again, leases are just simply legal contracts. So leases are one form of hybrid financing. They are used all the time. Now let's take a look at preferred stock. And we looked at preferred stock a bit already in this class. And remember, preferred stock is a financial instrument that has both characteristics of stocks and bonds. So preferred stock has characteristics of both stocks and bonds. And preferred stock is different from both common equity or regular stock and debt. Preferred dividends are fixed, similar to bond coupon payments. But remember back to when we were talking about default. If a company misses a preferred stock payment, it's not actually a default. They're not at risk of bankruptcy or anything like that. It's not going to make your preferred shareholders very happy, but it's not considered a default. So if a company's not doing well, they can say we're not going to pay preferred dividends this quarter or this term. Preferred dividends are cumulative up to a limit, and this part here is very important. Most preferred stocks prohibit the firm from paying common dividends if they can't pay the preferred. So if the company can't pay its preferred stock dividends, the regular stockholders, if they are due any dividends, they're not going to get them either. So companies, unless they really have to, often aren't going to just not pay their preferred dividends, for the reason being they wouldn't be able to pay their common stock dividends either. And it's obviously not going to make your shareholders very happy if you're now no longer paying dividends. So keep that in mind. But unlike bonds, you do not run the risk of a default if you don't pay your preferred dividends. What is adjustable rate preferred stock? In that case, it's preferred stock where the dividends are tied to the rates on Treasury securities instead of being fixed. So instead of just saying we're going to pay a 5% dividend, they're variable. So if interest rates go up, they go up. If they go down, they go down. And they can make what's an excellent short-term corporate investment. Here's why. Corporations like holding things like preferred stock. Because if you're a corporation, only 50% of those dividend payments you get are taxable. The other half is not. And since it's adjustable rate, it's generally going to trade very close to par value because the rate isn't going to change. Remember, securities can go under or over par when their rate greatly differs from the prevailing interest rate in the economy. Since they're adjustable, they'll generally trade very near par, so there's very little price risk. And as a consequence, you'll get these dividend payments that have beneficial tax consequences as well. But if the issuer is risky, if the company that issued the preferred stock is risky or very financially tenuous, that preferred stock may have still price instability. It may not have instability due to the interest rate changing, but it may have instability because you may think the company that issued it may fail or may not be able to meet their preferred dividends or something like that. So if it's really risky preferred stock, it may be too unstable for the liquid asset portfolios of corporate investors. Corporations that are sitting on a lot of cash invested in various things. They don't just leave it in a bank account. They still want to make money on it if they're not using it. Remember, your retained earnings can still make you money, and you have to take that into account when you're making decisions. So as a consequence, companies will like to invest in things like adjustable rate preferred stock of other companies. So how can a knowledge of call options, and we talked about options already a bit in this class, help you understand what are known as warrants and convertible bonds? A warrant is a long-term call option. Remember, a call option is the right to buy a stock at a certain price, and generally calls are when you think the stock is going to go up. When you get them originally, they're what is known as out of the money, meaning they're trading higher than the current stock price. But if the stock goes up, they can go what's called into the money, meaning you can buy the stock cheaper than it's now trading at. So a convertible bond is what is known as a fixed rate bond plus a call option. So understanding options can help make decisions regarding warrant and convertible bonds. So let's talk about both of these. Let's say a firm wants to issue a bond with a warrants package at a face value of $1,000, and warrants are options. So let's say our current stock price is $10. Our return on debt for a 20-year bond is 12% if it didn't have warrants. If it's just a regular bond like we looked at in previous chapters, 12%. But now let's say we're going to tack 50 warrants onto this bond with an exercise price of $12.50. That means each warrant is generally a regular stock option or the right to buy 100 shares of a stock at a given price. And now let's say we have up to 50 of them pegged onto each bond with a price of $12.50. Note, these warrants are not executable right now. $12.50 is more than 10. We wouldn't want to pay $12.50 for a stock when we can simply buy it for 10, but they are a type of call option. If the price of the stock goes up in the time we own it, we might want to execute those warrants. And each warrant right now is worth $1.50. Which would be comparatively priced to what these options would be for the same time horizon. So let's calculate the value of the bonds in this package. If you see a question on warrants, here's the following. The overall package is par value. And it's somewhere between the value of the bond and the value of the warrants. If this bond is coming with 50 warrants that cost $1.50, those warrants are worth a total of $75. So our bond is simply what is the warrants minus par, or $925. Our bond here is worth $925 itself. The other part of the package is the warrants. A bond with warrants, par value is always the total package, meaning what is the bond cost and what are the cost of the warrants. So whatever the par value is, it's a mixture of both. So our bond here costs $925. The other portion of what we're spending if we buy this package are the warrants. So if we want to calculate the coupon rate, so let's see right here, we have a payment of $110. How do we find that? we simply would use our payment function in Excel and key in the relevant information. We have an N of 20, the interest rate was given at 12%, PV 925, FV 1000. What is our coupon payment? And our coupon payment here is going to be $110 or an 11% coupon. So that would be how we would solve our coupon. Similar to what we did in past chapters, use the payment function in Excel equals PMT. And by doing that, it's going to give us our correct value. 11% coupon rate, $110 coupon payment. Now, what if we wanted to calculate expected rate of return if the warrants are tripped at $17.50? So if the stock price 5 years from now shoots up to $17.50, now those warrants are in your favor because we can buy the stock at $12.50. It's really trading at $17.50. So we're going to make $5 per share. So each bond is 50 warrants. Opportunity cost would be $250. Opportunity cost would be $250 here. So if you trip the warrants, you're buying the stock cheaper than you can on the open market. So there is an opportunity cost to the company. Simply, what's the difference between what's the stock worth and the warrant price by how many warrants there are. In this case, warrants can vary. They're just using it on an individual share basis. So 50 warrants, each warrant corresponds to 1 share. Here, they could be more. It would depend. Normal options contracts are one contract is 100 shares. In this case, each warrant is referring to 1 share. So the total opportunity cost means the company is losing $250 if you trip these warrants if the stock goes to $17.50, because that's what they could get on the open market, but you have a contract that they have to sell it to you cheaper. So what's the opportunity cost of capital for the bonds with the warrants here? We could find the IRR. So you would simply put in all these cash flows. We get $1,000 in year 0. Each coupon payment we have to pay back $110. In year 5, not only that, we have to factor into that money we're losing by the warrants being executed, then back to our coupon payments, and then in year 20 we have to pay back 1 more coupon payment and the par value. So you would simply put all of these into Excel and use your IRR function equals IRR and just go in order. Time 0 is plus 1,000, then negative 110, year 5 negative 360, and so on. And this would be our pre-tax cost, IRR 12.93%. That would be a way to solve that. Now, what if the firm is considering a callable convertible bond? So a convertible bond is similar, but it's different than warrants. So in the term of a bond with warrants, the warrants are just extra options tacked on to the bond. Depending on what happens to the stock price, they may get executed or not, but the bond itself is a normal bond. At the end of the term, you have to get your par value back and any coupon payments you receive. So they work exactly the same as regular coupon bonds we looked at, just with some stock options built onto them. That's why they're considered a hybrid instrument. Whereas a convertible bond is different. A convertible bond is a bond which can get converted into stock shares. So it can get converted into stock shares. So if we have a 20-year, 10% annual coupon convertible bond, it's selling at $1,000 par value, and if it was a normal bond, it would have a 12% coupon. So in this case, the company is going to call the bonds when the conversion value is going to exceed $1,200. Conversion ratio here is going to be 80 shares. The conversion ratio is going to be 80 shares. How do we get that? Just simply take 1,000 and divide it by our share price. Remember, our share price from the previous slide was $12.50. So you divide 1,000 by $12.50 or 80 shares. Meaning your $1,000 bond can get converted into 80 shares if you converted it. And in this case, if the conversion value goes over $1,200, the company is going to convert the bond. So we have a stock where price 0 is $10, dividend 0, 74 cents, and we have an 8% growth rate. So conversion price, once again, is found by dividing the par value of the bond by the conversion ratio. We get 1250 right here. And conversion price is usually set 10 to 30% above the stock price on the issue date. So our conversion price is higher than the current stock price. Why? Because if it was less, you would want to convert your bond immediately. So in this case, it is higher, so there's no benefit to converting right now. Because our conversion price, we would get less shares than we could buy with our $1,000 right now. So it's generally set above the current stock price. So what's its straight debt value? To find the PV, all you would do is like any other bond, number of years, interest, our payment, and our future value. And what would we get? Well, we would get a PV of 850.61. A PV of 850.61. So in this case, that would be our PV. So what happens if this bond now is convertible? Since the convertibles sell for $1,000, the implied value of the convertibility feature is just simply the PV of the bond taken away from 1,000. So just like the warrants, we have a total package here. Part of it's the bond, the other part is what do we assume the convertible portion to be worth, or $1.87 a share if we divide that by how many shares the bond would convert to. So convertibility value is very similar to the warrant value, meaning that the fact this bond is convertible to stock shares is worth $1.87 per share, or $149.39 of the overall package. So what's the formula for the bond's conversion value in any year? Conversion value is equal to your conversion ratio at price 0 times 1 plus our growth rate to the power of t. So if we want to know at year 0, it's simply going to be $800 right here. That's our conversion value, or less than we spent on the bond. Therefore, we would not want to convert the bond there. At year 10, if this stock is going to actually grow at 8%, our conversion value is now well over $1,000, $1,727.14. So you would obviously want to convert it at year 10 if you had the ability to. But since it's callable, the company is probably going to call it and convert it before this happens. And we're going to take a look at that in the next few slides. So what's meant by the floor value? The floor value is the higher of the straight debt value and the conversion value. So at year 10, our floor value is the straight debt value, $850.61, because it is more than our conversion value. It's not in our interest to convert this bond at year 0 because it's worth less than we spent on the bond. At year 10, the floor value is our conversion value, which is a lot higher than the straight debt value. Convertibles usually sell above floor value due to the fact that convertibility has additional value, as we saw before. So even though our floor value at time 0 is $850.61, that bond is going to sell at that $1,000 because the convertibility function has value to it. So when would the company expect to call these bonds in? Remember, a company calls a bond when, if they have the right to, they retire those bonds, and if they call a convertible bond, they're going to convert them to stock. So the company's going to force conversion when it's worth $1,200. So we can solve for that. If our PV is negative 800, so we're solving for the period of time until the conversion value equals the call price. So we start with a PV of 800, interest of 8% per year, future value of 1,200, and it would give us an N of about 5.27 years. So what that means is in a little over 5 years, the company is going to call back these bonds and convert them into stock. So what is the convertible's expected cost of capital to the firm if converted in year 5? So if converted in year 5, what do we get? just simply find the IRR once again. Start with $1,000 we get, and then our coupon payments, and then in year 5 we have the conversion value tacked on top. IRR here 13.08%. So is the cost of a convertible consistent with the risk of an issue? So to be consistent, remember, cost of debt is always the lowest, followed by cost of capital and then cost of equity. So since the convertible bond is a risk of debt, it blends the risk of debt and equity because it is a debt instrument that can be converted to equity. Return on our convertible, or RC, should be between the cost of debt and equity. So in this case, our return on equity, if we use the previous information using the formula we learned previously, would be 16%. So our return on our convertible is somewhere between our return on our debt, or our cost of debt, and our return on our equity, or our cost of equity. So it's in the middle. It's a blend of the risk of debt and equity. So that's something to keep in mind. So besides cost, what other factors should be considered when using hybrid securities? So what are the firm's future needs for capital? Exercise of warrants is good for the company because it brings in new equity capital without the need to retire low coupon debt. So if you issued low coupon debt with warrants, you get to bring in new money if those warrants get tripped. So let's say our stock price has been going up. Now those warrants are in the interest of the bondholders to execute. Even though we're going to get less than we could on the open market, we're still going to bring in new equity, and we don't have to retire that low coupon debt. That's really attractive if we retired that debt and issued new. If, let's say, that new debt, now the market's demanding a much higher coupon rate, we would, in that case, not want to do that. So we don't have to retire that debt, and we get to bring in more capital via equity. Conversion brings in no new funds, and low coupon debt is gone when the bonds are converted. But our debt ratio is lowered, so new debt can be issued. Why are convertible bonds attractive? What if we have too much debt? We have a lot of bonds issued. And remember, if you have a lot of debt, it can hurt your credit ratio. Not your credit ratio, your credit rating. We talked about bond ratings already. Your debt to equity ratio is too high. That's what I meant to say. But it can hurt your credit rating. And as a consequence, you wouldn't want to really issue more bonds if you have too much outstanding debt. By converting some of those bonds to equity, if they're convertible bonds, it brings our debt ratio down, and now we can issue more debt, and it may be more attractive for us to do so. If we retire a lot of debt, now we have a lot less outstanding debt. It's probably going to allow us to issue it at more favorable interest rates. So that is what is the benefits to a company of hybrid securities, such as warrants and convertible bonds. Finally, other issues. Generally, they're long-term securities. Does a firm really want to commit to 20 years of debt? Conversion removes debt, but warrants do not. When we convert a bond, that bond is now gone. They're now stockholders. Whereas if they trip the warrants, we get more money, but the original bond still exists. We still have to pay coupon payments, and it's going to exist for however long it's supposed to. If stock price does not rise over time, then neither warrants or convertibles would be exercised, and we're stuck with the debt. So these are attractive if we think there's a very good chance our stock price is going to go up. Because if it doesn't, no one's going to convert a bond, and as a consequence, we're stuck with the debt. And no one's going to execute a warrant if the price doesn't go above the warrant price either, and once again, we're still stuck with the debt. So hybrid securities are very good, but there are caveats. One being, if you don't think your stock price is going to go up at all in the next many years, you would not really want to issue hybrid securities. So keep that in mind as well. So that takes a look at both various types of hybrid financing, from leasing, which is very common, to things such as warrants and convertible bonds, and also preferred stock. And that is going to take us to the end of chapter number 20.